Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. We're at episode 282, and my guest is John Azar of Peak 15 Capital, Strategic Partnerships in U.S. Commercial Real Estate Investments. That's what we're talking about. We're going to talk about how he got there, how he started, but Peak 15 Capital is a hybrid boutique advisory and investment manager headquartered in Charlotte. And they also have additional offices in California, and they specialize in co-GP partnerships and direct investments. Let's go. This is episode 282 of Zen and the Art of Real Estate Investing with my guest, John Azar. John is the founder and chief executive officer of Peak 15 Capital. They are a capital advisory and syndication firm servicing commercial real estate operators and sponsors and identifying, sourcing, and securing their capital. John, welcome to the show.
Thank you so much. Appreciate you having me.
Yeah, I always say, I've done so many syndication shows, but it's so interesting because everything is a little bit different, and the way that you guys do it is different. So I'm excited to get into that. But when was the first time that you remember real estate being something you thought was going to play a role, now in your life?
Oh my gosh. I mean, when I first got into real estate, I didn't know it would play a role in my life. Yeah. I just thought it was, at that point, I wasn't thinking of real estate in terms of real estate. I was thinking of real estate in terms of a deal. Yeah. So yeah. I got into real estate back in 2004 or 2005. We were actually my two partners at that time, my firm back there, my first company that I launched in real estate was called Boston Venture Partners, and we were based out of Boston, and it was essentially three alumni from the capital markets. We were all equity traders, bond traders from Morgan Stanley, Royal Bank of Canada, Capital Markets Group. So we were all me and myself and my two other partners are alumni of these, and we came out of them because we had a deal that we worked on for a really long time, based out of Miami. It was a gigantic bond deal, $1.2 billion at the time. We couldn't really transact the bond, but during the course of actually doing the deal, we came across a lot of players and a lot of a couple of really big developers and project managers and architects. So some of the same people came back to us and said, "Why don't you guys? Would love to work with you if you open your own shop." And we said, "You got it. Well, fine. We'll open our own shop." So we that was the first sort of entree into real estate, my first company there. And we were really more like investment bankers for large scale mixed use development projects up and down the East Coast. Most of our projects were, $100 million plus, and there were either site contaminated projects or collaboration between public and private funding partnerships. We had projects, for instance, on couple of projects in Boston, Charlestown, Navy Yard. We have projects in Philly waterfront. We had a couple of projects in New York and Bowery district. So, we had projects all over. So I somewhat got a skewed version of getting into the real estate business because I got into it from a really high level perspective, meaning like the projects themselves were really large and like I said, $100 million plus. So I kind of worked there, and I kind of worked my way backward into multifamily at some point. My next company from that was the company I launched with we had with my brother called Mac Venture Partners, and we transacted only multifamily in the Southeast. So
I suppose when you're looking at these $100 million deals, that's not necessarily doable for yourself right away. So did multifamily intrigue you right away just from what you knew about the space in terms of starting there?
Yeah, it was definitely intriguing because some of the projects we worked on at Boston Venture Partners were residential.
Yeah.
It's just that they were large scale and they were different and they were in prime, class A location, class A type of projects. I mean, one of the projects we worked on was where the building where Tom Brady lived. So
yeah, these are can't miss projects,
Boston.
But regular multifamily is not.
Exactly. So, but yeah, it was definitely intriguing back then. But unfortunately, we got really hit hard from the recession in 2008. And by 2009, 2010, we had to close doors because pretty much our entire business evaporated overnight between 2008 and 2010, 2009.
Yeah, I mean, I've heard that story a lot. Obviously, it happened to a lot of good people in the business, but what led you to keep going in real estate? Like, of course, the recession happens, but some people were just like, all right, real estate's not the vehicle. Why did you still know that real estate was still going to be the vehicle for you?
Well, because, real estate will always be scarce. People will always need a place to live. People will always need a place to work. People will always need places to conduct their lives in general, whether it's living, working, taking care of their elderly, taking care of students, storing their stuff, putting their industrial equipment somewhere or having logistical warehouses. Real estate is an inevitable part of humanity in general. So you can't do humanity without real estate.
Yeah.
So I say it's part of the fabric of day-to-day life, whether we realize it or not. Everything is tied into real estate from working to living. And that's something I kind of realized early on back then, but I didn't have a chance to kind of dive back in. And we have to all kind of go back and get day jobs and pay the bills after we closed Boston Venture Partners. And then we relaunched again. I relaunched again with my brother in 2013, 2014, launched the syndication platform that we had. He had already been in that already, and he's accumulated a decent amount of doors before by the time we launched Mac Venture Partners, we already had some momentum in the marketplace with about 1,500, 2,000 doors. And then we continued to expand that platform and bought a few more thousand doors and transacted in the Southeast, mostly in the Carolinas, Georgia, Tennessee, Florida, and did that pretty actively until 2020. And that's when we started sunsetting the portfolio.
Yeah. Well, why'd you choose the Southeast at the time? Is it a price point scale perspective or building regulations easier, renovations, that type of thing? I mean, obviously now there's always weather issues in the Southeast, but there's a lot of scale. It goes up and down sometimes quickly. Yeah.
Yeah. I mean, the Southeast was just a natural geographic concentration for us, just because my brother was based in Charlotte at the time. At the time I was based in Boston, but he was based in Charlotte. So that was part of the decision making. And the other part was, the Southeast was really still is the darling of sort of the economics of multifamily. It just works better here from an economic standpoint, both from a yield on cost perspective to the user's perspective. I mean, the Southeast is still a great place for families to relocate, for young folks to come down and make a living. It's obviously real estate now is a lot more expensive than it was back in 2013, 2014, but still economically affordable compared to other major metropolitan areas like Boston, New York, Dallas, Austin, all those areas.
Yeah, I've been surprised that North Carolina still, in my opinion, remains pretty affordable. I mean, maybe people who have been there a long time don't think it's affordable anymore. But as you're saying, comparatively with what you have there and the access to everything that's there in a lot of the bigger cities in North Carolina, very strong value, and obviously doesn't have any showing signs of going down for any type of asset in those areas.
Yeah, that's right. You got it. And I mean, that expansion is still continuing, whether people recognize there's an expansion or not, even this day and age, as we're sort of contemplating where we are in the cycle. But that's why I'm always going to be a believer, and especially in multifamily. I mean, because multifamily is, look, at the end of the day, Jonathan, it's people need a place to live. Yeah. So it's, that's never going to go away. Unless we start doing away with people are always going to need a place to live.
I mean, AI is not going to take that away. I mean, it's just,
No, AI is not going to take that away. And then the ability for people to, to buy houses is unfortunately getting less and less.
Yeah.
The economic disparities globally is unfortunately is getting higher and higher. So folks who can afford a home and maintain a home are less now than they were before, regardless of what party's in the office.
Yeah.
So that's just part of the economics in general. And plus you have obviously the sort of a generational effect as well. A lot of the newer generation don't necessarily want to be tied down to
I agree.
a large, 20-year, 30-year commitment somewhere. A lot of them are smart. Some of them do buy and hold for investment purposes, which is great.
Yeah.
That is the smartest thing to do. But a lot of them don't even want that commitment. They just want to rent somewhere and kind of be able to be flexible and move on somewhere.
Yeah, well, I've talked about this a lot with other people in the space. I want to get your opinion on it. I completely agree with what you just said. And I think that your smarter young people are going to be choice renters, which is what I call them, and then find these real estate investments, whether it be early syndications if they're qualified as LPs, as accredited investors, or maybe they're looking for turnkey options so they can start to earn some scale on real estate, but not necessarily buy if they don't know if they're going to stay in an area or if their job's remote and it doesn't really matter where they live. It's just a different landscape since COVID with scaling prices. What do you think about that? Do you think that younger people are going to start to get into the syndication game as well? I'm trying to encourage them to, just because I think it's a smarter start than flipping a house.
I mean, some of them have. I'm conflicted of how enthusiastic I should be about that. I am always enthusiastic of people going into entrepreneurship, obviously. So I love entrepreneurship. Obviously, I would encourage anybody to try it, but it's not for everybody. I'm going to preface it by saying it's not for everyone. Not everyone is built to be an entrepreneur. Not everyone is built to be a syndicator. Yeah. So, and unfortunately in between 2021 and 2022, the proliferation of these, I'm going to call them fly-by-night coaching programs about you too can become a syndicator for nothing. Yeah. For no money out of pocket, you can own an apartment complex and become a millionaire, and you too can own this jet.
It's still out there. I agree with you. So, my thought is that they're going to look for LP opportunities, hopefully, and not try to be a syndicator before they're ready, because we know, that was part of the problem, as you're saying. A lot of people went in and say, look, I have a lot of friends, we have access to money. But now you don't know what you're doing as a syndicator, and you're capitalizing on stuff that you didn't know what was going to happen now, assuming you were going to have a same 3 to 5 year cycle. Now that's a 5 to 10 year cycle, and people are in trouble.
That's right. That's exactly what you hit the nail on the head. I mean, that's exactly right. You have folks that think, getting into syndication is just being able to just go to their friends and family and raise some money. Yeah. And that's part of it, but that's probably 25% of it.
Yeah. So, honestly, what I've seen in a lot of forums and from people I've talked to is that when people decide they want to invest in a syndication, they're kind of too busy, because that's why they want to do it. But then they're not even vetting, the operators. So a lot of times people look at the operators as a problem. They're complaining about them, and you look as well, what was your due diligence process like? They get ready to say, hey, I want to go passive. And then they see something that looks nice, which anything can look nice now. And then they just go in. And I'm seeing it's kind of almost like, hey, the first presentation of a syndication, they're like, yeah, it looks good, I'll take it. And that's part of the problem from the LP side.
Yeah, that's exactly right. Unfortunately, a lot of LPs got into these syndications and because it looked good, and they just didn't do enough deep dive. They didn't do enough due diligence, whether it's due diligence on the sponsor, due diligence on the operator, due diligence on what does that look like in 3-5 years? Yeah. What are your plans? Due diligence even on the assumptions of the operator. And I mean, that's really where a lot of those guys got in trouble, because they came out of these programs or whatever, and they may know the basics of underwriting. Yeah. But again, you can make your financials tell whatever story you want it to tell.
Exactly.
So it's really, the onus is on the investor to say, well, why do you think you can achieve 10% rent growth in the next 2 years? Those are the kind of questions that are going to tell you if they know what they're doing, don't know what they're doing, if they thought the market through, they have not thought the market through. And that's why a lot of those projects are in trouble now, because those faulty assumptions were rampant in 2021, 2022. A lot of it is, a lot of it's from I would say, the exuberance of the market itself.
Yeah.
It's just like any other bubble that happens. There's a certain amount of exuberance that's not reasonable and not prudent. And people who were buying these assets in 2021, 2022, thinking that the party of raising rents, 5, 10, 15% a year is going to continue for unabated for the next 10 years, is where they kind of fell short. And that's unfortunately, that's what happened. And, they bought all these things. We saw a bunch of those underwriting. We were in the market. But we didn't pull the trigger on a lot of deals because we didn't see deals that made sense to us. We had a ton of deals come our way from either sponsors looking for money from us, or looking for us to partner up with, or whatever. We've been in the sort of the in the liquidity space for a while.
Yeah.
So we've seen a lot of deals, and I can tell you a lot of those deals are now coming back to market at a ridiculously reduced price, because unfortunately the sponsors just ran out of money, and they pretty much the investors' money evaporated.
Yeah, and then that lesser deal isn't that great, because when they run out of money, they also run out of money to operationalize it. So not only is their value down because they couldn't get the rent bumps that you said, but also their operations aren't any better. Which is like, which value add are you doing? Neither. Now you're really going to decrease the value. So for then someone else to come in, it's like the discount's really still not worth it, because have so much soaked in it that they can't really get to the discount that it's worth.
Well, the discount is not only not worth it, but even if you go, I'm going to go a step further, and even the lender's price on those deals is not worth it.
I agree,
because we've gotten a lot of lenders come. We've had a lot of lenders come to us recently in the past few months, bringing us some deals at their cost basis, meaning at the loan amount basis. But even at the loan amount, Jonathan, they were overpriced, because at that time in 2021, 2022. Lenders were over leveraging. They were giving way too much leverage. So they were going in at 80%, 82% LTV, loan to value, on a project that was probably should have been 10, 15% lower from a sale perspective. So it's almost like a trifecta effect going on over here. You got over leverage, you got an overpriced, product that was being bought with an over leverage. And then the assumptions are faulty. So you combine those three things, and that's a recipe for disaster.
Yeah, and that's in multifamily. If you take it and turn it to office, you have a whole nother disaster, because office isn't coming back. It's like an interesting prophecy to see what kind of buildings are out there. But, I think it makes a lot of sense what you're saying, because it's just, when you look at who got into it, when they got into it, it was easy. You could get, the rates were super low, and they thought that they could trade out, in 3 to 5 years. But then when the rates went up, they knew they were in trouble, and they keep hoping it's going to come down so they can trade out. But now they can't trade out. There's no refinance option. It's way too high. They have to bring money to the table when they thought they'd be taking money home from the table.
That's right. And they're hemorrhaging money, and they start to not being able to pay their bills. They start to not being able to even pay their mortgage payment. Their debt payment, their debt coverage is no longer feasible anymore. And the thing that kills people even now is that they can't refinance. Because they're overpriced to begin with. So the product's even estimated value right now is not what it used to be in 2021, 2022 when they bought it. So they can't even have an option of refinancing.
Yeah, and they didn't get the rent bumps, so they're not getting any adjustments in the cap rate. They've stayed steady. Their operations are bad. And, the one thing that nobody talks about in all of these bad deals, everybody talks, the LPs lost the money, the GPs are in trouble, but it's terrible for the tenants. Because the tenants are getting the worst service. They're basically in a foreclosed, apartment building. So they're going to get the worst service possible. It must be really hard to be a tenant in one of those buildings that's in trouble, because who are you calling? No one's answering because nobody's getting paid.
That's right. Unless you have a seamless transitions in property management, then you're right. The tenants are definitely suffering as well in that equation as well. So it's just bad. It's just bad all around, obviously. And the smart ones who survive this kind of stuff, because there are some that did buy it and over leverage, and probably overpaid. However, the smart ones have over raised and in reserves. So if you have enough reserves, you can make it through, your time. You can buy your time essentially, till the market corrects or it gets better. Because listen, at the end of the day, time is the maker of all winners and the killer of everything as well at the same time. Yeah. If you have enough time, you can weather the storm. But the problem is most people don't have that kind of time. They didn't build in either enough money to help them weather the storm, and now they're out of money, so you don't. But if you have enough money to weather the storm and you can hold for another 2 or 3, 4 years, 5 years, you'll be fine at some point, because in the long term, real estate will always be fine. But the problem is, can you hold on to it that long?
Yeah, and that's the difference with residential versus large-scale commercial. You're not talking about a 30-year loan. You're looking at 5 years. Even if you're 5 years fixed, if you got 5 years fixed at 3, and now you have to refinance, you're bringing money to the table. If you got anything with variable, of course you're in trouble. So, I mean, there's so many ways that it can go wrong. And then, of course, you have to be scaling up operationally and rent-wise. And if you're doing a value add, that all has to go smooth so that you can upgrade that cap so the value goes up.
Oh, absolutely. Absolutely. And during all of that, you still have to pay attention to your occupancy and your tenant space. And, because if your occupancy drop and your collection drops, then you don't have, your lender's going to come down on you and say, well, not only are you not able to refinance, a lot of times you're most likely you're in violation of your loan covenants as well.
Yeah. Yeah, I'm curious, in all of your deals, have you gone into vertical integration in terms of property management with your partners on deals that you did, or is it something you stay away from? Because the way that I'm thinking of it is, I'm like, the people who were vertically integrated had a better chance of surviving because they knew that their property management wasn't a moneymaker. It was an operational saver in there. If you're paying outside, then those rates maybe go up, and it's just harder to do for everybody.
Yeah, I mean, yes and no. I mean, I don't think having in-house property management is the end-all be-all, and I don't think outsourcing is the end-all be-all. It just depends on how you manage it and how you kind of, because I mean, there's pros and cons to both. I agree. And we work with folks that have both. They third-party manage, and some folks are vertically integrated and have management in-house. Back when Tony, my brother, and I were pretty active in multi. My brother does have we were vertically integrated. My brother runs a property management company right now, still to date. So we were vertically integrated for us. Did it help us all the time? Probably not all the time, maybe, but it helped us a good amount. Yeah. What having to be vertically integrated helps you adjust very quickly and shift gears and cut costs if you need to. So you have a little bit more options there. But at the same time, the con in having a property management company in-house is sometimes you can't see your own faults. Like you try to change things, but you're only changing things according to your own knowledge. So nobody else on the outside is telling you, well, you're not really doing this right. And unfortunately, some people have too big of a head and they don't want to hear that they're not doing something right. So it's humanity's ultimate fault. Is this sense of vanity or whatever you want to call it. It's like no, what are you talking about? Like we're doing everything right. Like we just can't seem to get costs under control. Well, you can't seem to get costs under control because you're not doing everything right.
Right. So those two things don't work together.
So with third party management, you're able to say, well, it's just not working out. I need to switch it out. And then you bring in a new manager. You bring a fresh approach to managing your asset, fresh approach to managing your expenses, and hopefully it works better. So you have that optionality if you're a third party manager. You don't if you're an in-house manager.
Yeah, I think those are really good points. And I also think you can become a little bit too complacent when things are going smooth. It's like the best real estate operators are always tinkering and seeing where the little holes are so they can keep upgrading, especially as GPs for your investors. Oh, wait, we can save, by adjusting this water thing now. And you do that across 270 units, that little savings can turn into a big value add. And I think to me, that's always the interesting thing when I talk to people who do large scale multi. Very small changes that people don't understand. In a 6 unit, it's not really going to, move the meter much, but across 200 units, a very, very minor thing, a change in utilities or just an upgrade somewhere can really make the make or break where your out value is, especially with what we've been talking about.
Absolutely. I mean, it does. Scale makes a difference. I mean, you're dealing with a 300 unit complex, good and bad. Again, there's pros and cons to that.
Yeah.
So, I mean, if you're dealing with a 300 unit complex and you got, I don't know, 20 units or 30 units that are either had to get evicted, or you just, you have God forbid, you have some kind of a fire or something, you lose a building, you lose 20 or 30 units on a big project that's 300 units.
Yeah.
It's not that bad. It's 10%. But you take that same 20 or 30 unit on a 100 unit project, it's really bad. It's 30, but you're dropped down to 70% occupancy.
Yeah.
So, I mean, they're good and bad about bigger units as opposed to smaller units.
Hey, it's Jonathan. I hope you're enjoying this episode with John Azar. He's got it all together, but he didn't always have it all together, and neither did I. If you need bookkeeping assistance, I just ran into a good guy, Max Emery at Time Capital Bookkeeping and CFO Solutions. He's going to be on the podcast soon. He can help you. If you want to get a free bookkeeping consultation and a bonus deal clarity diagnostic, you can use my link, bit.ly, that's always bit.ly/TCZen. And the TC stands for Time Capital, which you can save. Now let's get back to more time with my guest, John Azar. For you, across your career, what's your preference in terms of unit count for multifamily? Is there an amount that's too much, like too many units, because it's going to change and your end buyer is different, if you're getting up over 250 or something? Or are you looking for that end buyer to be those big funds who are going to sweep it up in the kind of in the purchase phase?
You gotta, it's all about how you're managing it. You can manage a 100 unit building as well as a 500 unit building. It just depends on how you're managing it and what you have in place that is realistic to manage the asset itself. So if you have a 100 unit asset, obviously you're going to probably have one in one, maybe one in, one manager and one outside. Yeah. If you have a 300 unit asset or a 500 unit asset, then obviously that's going to multiply. And if you're not doing the right multiplication, and if you're not handling it, if you have a 300 unit asset, you're trying to run it with 2 people inside, you're probably going to fail. Yeah. So it's just not going to work. So you have to have the right people. You have to make sure going into it with your eyes wide open that, hey, if I have a 300 unit or 500 unit asset or an 800 unit asset, I have to make sure that the right property management is in house, is in place, and we're handling things right. I'm not going to tell you, Jonathan, that a 500 unit asset is better than a 100 unit asset. And I'm also not going to tell you that a 100 unit asset is better than a 500 unit asset. It just depends on what you're looking for. For us, we prefer to go slightly bigger just because it helps us move the needle on our capital more. We work mostly with institutional investors as programmatic partners. So when they deploy into our project, they want to have bigger checks. They want to have that $10 million check size and above. So that really right there and there dictates the size of the asset. You're not gonna have a 50 unit asset that requires $10 million to be brought into it. Yeah, so,
I mean that's knowing your own avatar for who you want for your investments and who the most reliable suitors are for what you're doing.
That's right. So, I can tell you the only differentiation is if you're starting out, it's probably easier to start out low. Probably, and that's why I tell people, when we do, back when I did coaching, we used to have a coaching program a couple of years ago that we stopped because I'm more of a deal guy than a coach. I love deals. So the deals took over and growing the business was the priority. Although we're actually coming out with a course in the next month or so that's for a multifamily. Yeah. That's going to be offered starting in September. That we've developed in the past few years, and we're coming out with that in September. I can tell you more about that later. But bottom line is if when we are coaching people or somebody's asking us what do you like, I say, look, if you're starting out, just start small, because it's easy for you to digest and easier for you to maneuver and manage. Because if you're buying a 30, 40, 50 unit asset, it's a lot easier for you to manage just from a logistics standpoint. You're, especially when you're first starting out, because you need to get your sea leg underneath you as you're managing. Even if you hire a property manager, like you might have a problem with 1 or 2 units, and you have to figure something else, but you can figure that out easily. When you're dealing with a 150, 200 unit asset, then you have your headaches multiply. You have to know what to deal with 20, 10, 15, 20, 30 units at the time. And you got to manage workers. You got to manage the construction. I mean, it's a whole different game. So, but if you have that knowledge already, then go for the bigger. That's great. But if you're starting out, go small.
Yeah. And I think it makes it, because who you're selling to eventually makes sense, unless you're planning on a lifetime hold, which not that many people are. Because if you're only at 20 or 30 units, you're pretty much open. You have every buyer in the book really there, because it's not institutional buyers aren't coming in to snap up a 20 unit unless they're getting it as a portfolio with, another 500 or 1,000 units. So it kind of makes it like it doesn't have to be perfect on your first thing. You don't have to have a perfect system at 20, because someone else can still make money and then operationalize it better. But if you're at 250, somebody's going to want this thing really tied up with a bow. So I definitely wouldn't want to start there. I think that's probably just a big chunk.
No, that's a disaster. You can't start up that high. That's just asking for trouble.
Yeah. Have you dabbled in other asset classes besides multifamily at all?
Oh yeah. Yeah. I mean, our fund right now is asset type agnostic. So we are not just a multifamily. Right now in our fund, we have we have ground up development, we have BTR, BTS.
Oh, nice.
Built to sell community.
Yeah.
We even have a portfolio of car washes in our portfolio right now. So it's not just multifamily. Our current fund, we also do industrial, but our next fund, we're launching our next fund Q2 of next year. That will probably add a couple more asset types to it. On our next fund, we want to add senior living, student housing, and self-storage, which we don't have right now in our current fund.
Yeah, and is that all for just the sake of diversification? I mean, when you look across, especially with your background at Morgan Stanley and everything before that, it's like the way that I've always looked at investing, whether it be real estate, stocks, anything, my whole portfolio, diversification is key. And when you're doing a fund, okay, you can diversify in multifamily, geographically, unit size, operators, everything like that. You can kind of figure that out. But I really like the idea of what can happen, with multifamily versus storage versus industrial. And like you said, even car wash, because car wash, a lot of times you have underlying real estate or you have triple net options. There's just a lot of cool things that you can do with those things that are businesses on land. So you get kind of all the benefits. Yeah,
diversification for us, I mean, it's not just about, if you stick to just multifamily, the only diversification you can bring on board is geographic to some extent. I mean, you're geographically diversified, but we wanted to bring more than just geographic diversification to our fund and our fund investors. We wanted to bring them diversification of the type of cash flow that we bring, diversification of the profits. So we have, like as I said, we have ground up development projects in our portfolio right now. Well, those ground up development projects are not going to pay cash flow so those are going to be
car washes pay right away because they're always making money.
Car washes, however, are paying us huge cash flow. And in fact, the cash flow that car washes generate, I can't even duplicate in multifamily. Yeah. It just doesn't happen. I don't have 14, 15% cash on cash in multifamily. I do with car washes. So we integrate car washes as an example to help increase the alpha for our investors, the return alpha for our investors from a different diversification standpoint. Obviously, the ground up development projects are going to be a gigantic profit center upon the liquidity event. But again, you're not going to have those for 2 to 3 years during construction, and during that time, you're not making any cash flow to your investors. So you got to have a mix of stuff, and then and then we layered in a couple of other asset classes like industrial and even BTR and BTS. Those have a different sort of return parameters to our investors. So we're really trying to go after true diversification.
Yeah.
But the common denominator is the returns. We're always trying to go after the best returns that we can possibly provide to our investors.
Yeah, but like you said, the diversification can be in the returns because you're scaling when the payouts are. And I think that becomes more interesting to a fund investor. If I'm investing in a fund, like the reason I got investing in syndications, I so far I just invest in one-offs because I don't want to operate multifamily, but I like having access, like being a part of multifamily without having to do anything. But if I was going into a fund, I would like the option to have a couple things because then I feel like, hey, I'm getting a little taste of car wash, getting a little taste of industrial without having to be an operator myself. And each year that I get older, I want to be active less and less. I want to be smart, passive. I'll be maybe choice active. Like now, may go back and do some short-term rentals just because I find it enjoyable. But I think I want to trust the people to know. And when you look at a bin and it has a bunch of different stuff in it, it just inherently makes me feel safer as an investor.
Exactly. And we are very sort of open house, collaborative type of fund manager. We even tell a lot of our investors, look, if you want to really kind of look underneath, the hood and find out what's going on, and you really want to kind of get up your knowledge with this investment, come out and join us. Come out and join us on site tours. Come out and join us with one of our assets when we go visit one of our assets. We're always happy to take our investors to actually be on the ground with us if they want to, if their aim is to like learn more but without having to be. It's almost like a grandkid. You know what they say about grandkids. The grandkids, you can take them, play with them. They're great. They're cute babies, but you can always hand them off to somebody else to take care of them. You
feed them a lot of sugar and then you send them back to their parents to teach them a lesson for what they did to you. I mean, my kids are older. I don't have grandkids yet, but I know what I'm going to do.
Exactly. I don't have grandkids either, but I mean, I see it from other people like having grandkids. I'm like, it's just, that's what I'm saying. As funny as that sound, our fund is like that for folks. It's like, an opportunity to be able to enjoy the kids and, enjoy their, and go in on the ground, look at what look underneath the hood, see how things are working.
And then go out on the boat.
But then go out on the boat and not worry about handling, the financials and handling, who's doing that and the project management and all that kind of stuff. So that's how I look at it.
Yeah, and I think when you were talking about the site tours, it reminded me of something you were talking about in the beginning, which is really like why real estate is such a great asset, because it's tangible compared to these other things. Stocks, bonds, you can't value add them. You can't really like hold them or look at them. But even as an LP, I can go to the buildings if I want, like you're saying. You can see, you can just go on Google Maps or you can go on a website. Wow, like this really exists. And then, not only does the building exist, but the land underneath it exists. It's there.
That's right.
So even if the building burns down or something happens, you can just rebuild it. And I think that's the thing that a lot of people get more attached to, because I still like stocks. I think they're really important in terms of diversification, but it's just not tangible. I don't have anything and I can have zero influence. In a syndication, I can have zero influence, but I'm still betting on the operators to have influence in the process. And I know that it can go up by what they do.
Yeah. Oh, absolutely. Yeah. And as like I said, the investment is tangible. It's there. It's not, you're not investing in a stock that you're hoping that, hey, if the company perform, maybe that stock will increase or if their technology takes off, the stock will, you're betting on an actual real estate asset. So you can actually tangibly go look at it, feel it, touch it, visit it, as opposed to something else.
Yeah, and a lot of time, when you're looking at large assets and then you see it, you're like, well, this is, barring a disaster, like you can see it, like it's a, 2020 build to 100 units. It's in great shape.
Right.
It looks really nice. Who doesn't want to live there? You kind of can just walk away feeling good about it. Yeah, I think that's kind of the underlying adjustment for people who start in stocks and then they get into real estate and stay with stocks, but it's just a different feeling to know that you can have it. I always said, like growing up, as we had more assets, my sister and I said, if everything goes crazy in the world and we have 10 rental properties, like we could just go move into one. You just give yourself more options, because as you were saying, it's something that somebody's always going to need. You can move your business into one. That's why I like mixed use. It gives you so many options when you have it available.
Absolutely. You're absolutely right. Yeah, you're absolutely right. You can shift gears and do things differently on the drop of a hat to some extent. Absolutely. Yeah.
Yeah. And so for you guys at Peak 15, you do a lot of like kind of co-GP type of deals, right? People are coming to you looking for, sometimes they have an asset, sometimes they're looking for financial assistance to get in. There's a lot of different models that it seems like that you guys do.
We do. Yeah. I mean, people generally come to us looking for not necessarily just money. They, obviously money drives, how we invest and where we invest. But a lot of times people come to us because they're looking for extra firepower when it comes to the lending part. So they just don't have enough bandwidth on the lending side to qualify. So sometimes they need us, and when I say us, I'm me for now. I mean, we're working on getting a couple of my principals to be up to par to where they can also sign, but they need someone to co-sign with them on the loan, whether it's from a net worth or balance sheet or experience or whatever it might be.
Yeah.
So sometimes it's that. Sometimes it's not. It's not about the money. Sometimes it's a combination of money and sometimes it's really just purely about the money. They just need an extra $1 million, on the GP side because they raised everything else on the LP side, but they are short on the GP side of the economics. And that's really where we shine the most. Our fund is really formulated to be a co-GP vehicle and a liquidity vehicle for sponsors, developers, operators.
Yeah. Well, it puts you in a good spot, though, because in all the scenarios, even though they're different, it's somebody needing something from you. So you have the control over the situation instead of the other way. Like they could be in a really tough spot. So it helps you obviously leverage potential terms, get the best deal for yourself inside of that, but also to make sure that, you're looking at it. When you're looking at all these deals, just in general, obviously we're talking generally large scale multifamily. What makes you say no to a deal? What are the things that you look at and it's just like, oh no, that's not looking good? Because I think that will help even people who are newer to the game, who are thinking more passively, kind of figure out what the red flags are. If you see them, they should be seeing them, but they may miss them.
Yeah. I mean, listen, I want to preface this by saying we put equal weighting on the people as much on the deal.
Yeah.
So a lot of times the deal doesn't work for us because the people don't work for us. So the deal, we underwrite the deal 10 ways till Sunday. We are very conservative underwriter, very conservative. So, my CIO and partner, Francisco, we call him the death merchant here. And because his job is not to make deals work. His job is actually to kill deals.
Yeah.
So that's his priority. His priority is to kill. So when a deal comes to us, he tries to kill it. That's his objective is let me see how I can kill this deal. And if he can't figure out a way to kill the deal, then it's a viable deal for us. For us to so you got to play with the levers. So the assumptions are really important. The assumptions are gigantically important. I mean, that because the assumptions I mentioned earlier in the show when we were talking that your numbers you can make them tell whatever story you want to tell them. So the numbers are really built around your assumptions. If you're assuming that you're going to have a 10% rent growth in a market that only warrants 2% rent growth, you've lost me right then and there.
Right.
And,
right.
You're bringing me a deal that you're like, oh, we're gonna be great. We have a 5% projection year after year. I'm like, nah, that's not gonna work. That's not nearly as conservative enough.
Yeah.
Or you have no capex estimation. You're like we'll fund it on operation. And that's never something we do. We never fund capex on operation. Capex should always be funded upfront day one when you get into the property, not let's figure out how to fund this 2 years from now.
Yeah. Those both sound like inexperienced people presenting to you, because it just they almost seem silly to me, like to even present that to somebody like you, because it's obviously it doesn't work. They must just be scratching for something there.
So it ends up the deal not end up working because of that sometimes, but sometimes you'll be surprised. Even some experienced people overestimate sometimes I'm using bigger numbers here, but sometimes it's a lot smaller numbers that we don't agree with. Like, I mean, maybe their assumption is that, we're only estimating a 3% rent growth on year one. I'm like, well, why are you not assuming 0 rent growth on year one? Because that's what we estimate. That's what our underwriting criteria is. We underwrite projects for 0 rent growth in year one. And if they're not, you have to give me a really damn good reason as to why they're not. It's not a 0 rent growth assumption in year one. And then year 2, you can start to slowly increase. That could be one, or the way that you're looking at your exit cap rate. Your exit cap rate is also a hugely important figure, because that really determines your IRR. Again, when I said earlier, you can make your pro forma sing whatever song you want it to sing.
Yeah.
That goes part of it, because you can look at some syndication. You're like, damn, it's going to be a 30% IRR deal in 3 years. Well, how did they get that 30%? They got that 30% by probably overestimating what their exit cap rate is going to be. If you're in a market where the average cap rate for let's call it a 2020 built apartment complex is, I don't know, and the average cap rate is let's call it 5.75% or 5.5%. You're coming at me and telling me, well, I'm going to sell this in 5 years, and I'm going to estimate it's going to be 5.25% or 5%.
Yeah.
So you have a cap rate contraction as opposed to a cap rate expansion on your assumption. That's going to kill the deal for us, because we never do cap rate contraction when we're doing our underwriting. We always do cap rate expansion, meaning that you're adding to your entry cap rate when the time you exit your property.
Yeah.
So that's one reason. The other reason, obviously, is the people. Like I said, we underwrite, and the people have to work. Like do they have the right capacity in place? Have they done deals in that market? Have they done a full cycle deal in that market? It's okay if they haven't done a full cycle deal, but I want to know that they know the market well. I know that they know how to operate in that market. Have they thought about the property management? Who's going to handle that? What's their framework of choosing the property manager? What are their ideas of like the loan parameters? How are they looking at the loan? Are they going for agency loan, or are they going for bridge? And if they're not going for agency, they're going for bridge. Why? Is there a reason that makes it better or worse and a lot of time, sometimes there is. Sometimes you don't have to always go with agency. Sometimes you can go with bridge and be fine. Yeah. You just have to know why you're using certain parameters. And then, and then there's one criteria that the folks inside of my company always pick on me on. It's the touch and feel of the person.
Yeah.
I have to, one of the principals have to meet that person live in person before we consummate a deal together. Why? Because you can tell a lot about a person when you meet them live and in person, and you shake hands and you look somebody in the eye. Yes, that's a less measurable criteria, I would say, but it's my criteria, because you sometimes, and you have to trust your gut on that. Sometimes you meet people and you're like, I don't know, I got a weird feeling about this guy.
Yeah,
I don't know if I want to do a deal with him. If you have that feeling, don't do the deal.
I agree.
Because it's not going to get any better. If you have a weird feeling about somebody and you do a deal with them, guess what? You're stuck with them for the next 3 to 5 years.
So that
if something goes wrong,
never going to work. Don't you think you can look at it like, I can just see the scenario. I really don't like the person. I don't trust them, but boy, this deal looks good. But you just told me you don't trust them.
Yeah, exactly.
That's how you get to these 30% IRRs. Like, it doesn't make any sense. But I'll go back to what you're saying about the assumptions. It's like, is this an assumption based on fact or an assumption based on hope? And a lot of it is hope or best case scenario. I don't want to see the best case scenario on investor. That I want to see basically not necessarily the worst case scenario, but a very reasonable scenario that would be very hard to go less than. Because if I'm comfortable with that, and I'm comfortable with the operator, like you said, I've done that. I really feel like they're good. We're going to crush that, most of the time, because you're really starting at the bottom. And I think that's, the difference between how people are presenting, because now it's not just a sales mechanism, you and me, where, you can really see, this person's kind of bullshit. It's internet sales.
Of course.
People are getting syndication deals on TikTok, which is crazy, but people are being influenced by social media, and you only need to be good on camera for like 32 seconds to influence someone that way.
That's right. Yeah, you're absolutely right. You're absolutely right. And yeah, may not be something you can exactly measure logistically and define, the whole people aspect of it, but you should trust your feeling. You should trust your gut. I will always pass on a good deal if the people just don't make sense, or the people just, something doesn't feel right about it. Because I don't care how good the deal is. A good deal can go sideways really quick with a bad partner.
Bad person. Yeah, of course. And I won't regret it later. If it goes well, good for them. Just wasn't the one for me.
That's right.
You're talking about a course that you guys are going to launch. And by the time this episode launches, it's already going to be available. So tell us a little bit about that.
Yeah, it's basically an accumulation of the coaching programs we've done before, obviously the operation. I mean, it's basically our distilled knowledge on multifamily. This particular course is going to be just on multifamily.
Yeah.
It's going to be it's a multifamily accelerator. That's what we're calling it. It's basically soup to nuts on buying, owning, operating, financing, capitalizing multifamily, and pretty much from identification to acquisition to disposition.
Yeah.
So pretty much essentially the full cycle. And our course has more of a sort of if you want to go more institutional, it has a more institutional twist to it. So you get into the business, and knowing that you're going to get into the business and doing multifamily with an institutional focus at some point or another. It doesn't have to be right away. The course teaches people how to identify and acquire multifamily, even with just mom and pop fundraising and individual fundraising, but it also gets them ready for an institutional raise at some point, because the follow-on course after that is we get them. The one we're going to release afterward is going to be getting ready your property for a bigger institutional play.
Yeah.
So it's soup to nuts, acquisition to disposition and management and capital raising, all in one course. We're going to kick it off with a boot camp in September. That's going to be a 3-day boot camp. And then from that boot camp, it's going to be offered as a standalone course that folks can buy and access.
Awesome. And is that going to be at peak15cap.com?
Yeah, there will be information on it at peak15cap.com, but they can also connect with me. I'm on LinkedIn and Instagram, and happy to connect with anybody about that course. But there will be forthcoming announcements and marketing on it starting probably in the next few weeks that we're going to start marketing it.
Yeah. Awesome, man. Well, I really appreciate the time. I always love talking multifamily and other assets as well, and funds. So it's been a pleasure having you on the show, and I look forward to staying in touch.
Absolutely, man. Absolutely. Jonathan, thanks so much for having me. And I'm going to just throw out my email if anybody want to reach out for anything. It's Azar at peak15cap.com. It's AZAR at peak15cap.com. And always happy to lend a hand, be a listening ear for anybody who wants to ask something about the industry or just want to get an opinion.
Yeah. And remember, Peak 15 is PEAK, and then the number 15, cap.com. You can find it in the show notes. John, I really appreciate it. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. It's Axel Ragnarsson from Aligned Real Estate Partners. What do? They provide everyday investors with access to vetted multifamily real estate investment opportunities, minimal fees, aligned incentives. When they win, their investors win. We'll see you next episode with Axel.